Hello everyone, and welcome to this new video on leverage tokens. Today, we'll explore the safest way to trade with leverage, so without the liquidation risk. So, we'll start with the basics of leverage, then dive into how leverage tokens are rebalanced and the impact of this rebalancing. After that, we'll go through a tutorial, and finally, we'll wrap up with a review. Let's start by looking at the basics of leverage and understand how leverage works. To trade with leverage, which allows you to considerably increase your gains and losses, we have to trade futures contracts called perpetuals. These perps are very risky because you can be liquidated and lose everything quickly. For example, here we have our perps list, which are tradable. If we want to open a long position on Ethereum with a 25 leverage, we can see here the liquidation level in orange. It means that if the price reaches this level, we lose everything, so it's very risky. But don't worry, leverage tokens remedy this. Let's now understand how leverage is calculated. You, the trader, have to choose a broker, for example Synthetics Exchange or DYDX, and you have to send them a margin which corresponds to the trader's capital. Then the broker will allow you to borrow some funds and will transmit the borrowed fund plus your margin to the market. The leverage equal to the total position value, divided by the margin. But be careful. If the liquidation level is reached, you lose your margin and the broker recovers the funds you borrowed from him. So we have leverage equal to borrowed funds plus margin, which correspond to the total position value, divided by the margin. For example, let's assume you put a $100 margin and you borrow $900. We have this equation which permit to calculate your leverage, which is equal to 10. Now, let's assume that your capital decreases, so your margin falls because the price is moving against you. Your margin become $85, your borrowing is still $900, and so the new leverage is equal to 11.59. Your leverage has increased. In the same way, let's imagine that the price moves in your favor and your capital increases. Your borrowing is still $900 and your margin become $115. Your new leverage is 8.83. Your leverage has decreased. To summarize the functioning of perpetual future, if your margin increases, the leverage will decrease. Inversely, if your margin decreases, that is, the price has moved against you, your leverage will increase. In addition, if the price reached the liquidation level, you lose the entirety of your margin, and the broker recovers the funds that you borrowed. Let's get to the heart of the matter and talk about leverage tokens and their rebalancing. First of all, you must understand that leverage tokens are backed by perps. It means that when a leverage token is created, a perpetual future with the same leverage will be created in the back end. However, there is no liquidation risk on the leverage token, while there is a liquidation risk on the perpetual. How is this possible? It's because leverage tokens have a constant leverage. Indeed, rebalancing allows to keep a constant leverage on the perps that backs the LT. Let's analyze this in more depth with a concrete example. Do you remember this example where the trader's margin falls? We saw that the leverage was increasing, and this equation proves it. There is no rebalancing. Let's take this example again, and for which there would have been a rebalancing to keep the leverage constant, that is to say, at 10. The trader's margin has therefore gone to $85. To keep the leverage at 10, the broker must therefore decrease the position and lower the $900 of borrowed funds to $765. So the ratio is still equal to 10. The size of the position will therefore decrease, but the leverage will remain constant thanks to this rebalancing. So if the margin goes down, rebalancing decreases position size to keep a constant leverage. In the same way, if margin goes up, rebalancing increases position size to keep a constant leverage. This is what differentiates perps from leverage tokens. Let's see now when liquidation events occur and who rebalances your position. Rebalancing occurs when the leverage approaches the borders of the range. For example, here, the leverage token ETH5 long has a current leverage of 4.9, The leverage range is between 4.20 and 6.33, which means that as soon as the current leverage approaches these values, a rebalancing event occurs. As for the who, it's keepers that trigger the rebalancing events. These keepers are decentralized and reliable, managed by chain-link automation, in other words, by bots. Let's see the effects of rebalancing and how powerful it can be. First of all, there is no liquidation. In fact, by decreasing position size with rebalancing, risk is reduced, because instead of increasing the leverage is still constant. Thus, liquidation level can be adjusted to never be reached. For example, in this screenshot, we have a 50 leverage with 3.59 Ethereum. And we can see that if the position is decreased, the liquidation level can be adjusted to never be reached. Secondly, there is less risk when the markets moves against you. In fact, keeping leverage constant prevents it from increasing. Unlike with perps, it limits your losses. So, this table summarizes the fact that there is less risk. We will compare the performance of a perpetual with the performance of a leveraged token on ETH with a 2 leverage. If ETH loses 5% and then loses 5% again, your return on investment will be negative 19.5% for a perpetual. If a rebalancing event occurs in T2, leverage is kept constant rather than increasing, limiting T2 loss. ROI for leveraged token is therefore negative 19%. So we lose less with this asset. There is also more gains. When the market moves with you, keeping leverage constant prevents it from decreasing, unlike with perps. It increases your gains. Here's the same table as before, but instead of -5% followed by -5%, we have +5% and +5%. The profit on a perp with a 2 leverage would be +20.5%. Whereas, if a rebalancing event occurs at T2, the profit would be +21%. This means that leveraged tokens enhance returns compared to perps. But beware, there is a risk, which is called volatility decay. It happens when price moves against you and then with you. The consequence is when your margin decreases, a larger price movement is needed to recover it compared to perps. It's because leverage with LT is constant instead of increasing. So, this table summarizes volatility decay, and we can see that with a 2 leveraged perpetual, if Ethereum drops by -5% and then rises by +5%, the final performance will be negative 0.5%. However, if Ethereum goes down by 5% and there is a rebalancing, meaning that the leverage is kept constant instead of increasing, the performance on the +5% on T2 will be less, because the leverage has decreased compared to perps leverage. The ROI will be negative 1%. This is the biggest risk associated with leveraged tokens. Okay, let's see a quick tutorial to trade leveraged tokens. First, you have to know that this tutorial is for decentralized finance guys. I'm totally against centralization in Web3, so all my tutorials will be done directly on the blockchain. Go to your favorite browser and type Synthetics. Click on synthetics.io here. 2 options are available, trade perps here or trade leveraged token here. We're gonna click on this button. We'll then connect our software wallet. My MetaMask is directly connected to my ledger for even more security. Then click on Mint Leveraged Tokens. We arrive on this page, and we have the list of all the cryptos available for trading with leveraged tokens. We select Ethereum, for example. We choose the direction of our trade here, long or short, and the leverage we want, for example 5. We enter here the amount we want to trade. We can trade with all these currencies. Be careful. I recommend to pay with SUSD to avoid the price impact here. You can find the leverage token information here, like the current leverage, the leverage range, which will trigger a rebalancing event, the address of the token, and the total money used to mint this specific token. All that's left is to approve the transaction by clicking here, and validate the transaction with your wallet. So, a quick conclusion about this video. First, let's compare the benefits of the leveraged token and the benefits of the perpetual future. There is no liquidation with the leveraged token. There is more gain with the leveraged token. There is less risk with the leveraged token. However, LT has volatility decay, while perps do not. This is the only major risk associated with this asset. LT maintains a constant leverage via rebalancing, eliminating the need for margin management. LT is less stressful than perps, because there is no liquidation. And finally, it's a very easy-to-use asset, instead of perps which require good knowledge in trading, risk management, money management, and leverage. Thank you for joining me, guys, and see you soon for another application that Web3 has to offer.